All right, let's get right into it. We're going to pull back the curtain on the world of corporate finance. We're breaking down exactly how companies get their hands on the billions, yes, billions they need to grow, to innovate, and to completely dominate their industries.
You know, you see a company go from a garage project to a name everybody knows, and you just have to ask, where did all that money come from? I can tell you, it's not magic. And in those early days, it's almost never just from sales.
It all comes down to one thing, raising capital. But this isn't a one-size-fits-all kind of deal. Companies have this whole toolkit of financial instruments, and each one is designed for a very specific job. So let's open up that toolkit and see what's inside.
So first up, we're looking at a method for companies that are already publicly listed and need a serious amount of cash, like yesterday. It's called a Qualified Institutional Placement, or QIP for short.
Think of a QIP as a private VIP sale of shares. But the guest list is super exclusive. It's only for the big dogs, the institutional investors with deep pockets and the expertise to match. They don't need all the regulatory handholding that a normal investor does. This is the absolute express lane for corporate fundraising.
So why would a company do this? Well, it's all about speed and efficiency. They get to slash through a ton of red tape and avoid the massive costs of a full public offering. It's just a streamlined process designed to get cash in the door as fast as humanly possible. Plus, it has the nice little side effect of keeping capital in the domestic market.
And we are not talking about chump change here. Just to give you some perspective, the banking giant ICICI Bank raised a mind-blowing 150 billion rupees. That's roughly $1.8 billion in a single QIP. Just one deal. That shows you the sheer power of this tool.
Okay, but fundraising isn't always about the raw numbers. Let's move on, because sometimes it's really about getting the right people in the boat with you, whether that's a strategic partner who can open doors or a founder whose ideas are the real capital.
So here we have two totally different plays. On one hand, a preferential allocation is where you offer shares to a specific group to lock in some kind of strategic advantage, like bringing on a venture capitalist who has all the right connections. Then, on the complete other side of the coin, you've got sweat equity, which isn't about raising cash at all. It's about paying invaluable people with the most valuable thing a new company has, ownership.
Sweat equity is the lifeblood of a startup that's got a huge vision but an empty wallet. Can't afford that top-tier engineer's six-figure salary? No problem. You offer them a piece of the company you're building together. And what's brilliant is that it aligns everyone's goals. If the company takes off, everybody's piece of the pie gets a whole lot bigger.
Now, this might sound a little abstract, so let's run the numbers and see how it actually works. An entrepreneur's hard work and ideas value their company at 40 lakhs. Then an investor comes along, puts in 50 lakhs for a 20% stake. And boom, the company is suddenly valued at 2.5 crores. The founder's original stake is now worth 2 crores. That incredible 1.6 crore jump, that is the financial return on their sweat. This is literally how people build fortunes from nothing but an idea.
So once that kind of value is created, a company's ambitions tend to grow. They start looking beyond their own borders. And to become a true global player, you need to tap into the massive pools of capital sitting in places like New York or London. This is when they decide to go global.
Right, so how do you make it easy for an investor in America to buy shares in an Indian tech company? You can't just expect them to figure out foreign brokerage accounts and deal with currency conversions. It's too messy. You have to bring the investment right to their doorstep.
And for the US market, the answer is actually pretty brilliant. It's called an American Depositary Receipt, or ADR. Basically, a US bank buys a giant chunk of a foreign company's shares. Then it issues these receipts that trade just like any other stock on the New York Stock Exchange or NASDAQ, all in good old US dollars. It makes investing in a foreign company completely seamless.
But, and this is important, not all ADRs are created equal. There are levels. Level 1 is kind of like dipping your toe in the water. It's the easiest to set up, but you can't raise new money. Level 2 gets more serious. You have to register with the SEC and investors get voting rights. But the holy grail, the one everyone wants, is Level 3. It's the most work, but it's the only one that lets you issue brand new shares and raise fresh cash directly from American investors.
Okay, so that's America covered. What about the rest of the world? Well, the concept is pretty much the same, but it's called a Global Depositary Receipt, or GDR. Just like an ADR, it's a certificate that lets you trade foreign shares, but this is for markets outside the US. Think major exchanges in London, Luxembourg, or Singapore.
And the amount of money we're talking about here is just staggering. Take the Indian tech giant Infosys.
They went to the Luxembourg Stock Exchange and raised almost $500 million with a single GDR issue. Just like that, they had access to a huge pool of European capital.
And this isn't just a tech thing. Industrial powerhouses like Tata Motors did the exact same thing, raising over $124 million to fuel their global expansion. It's a proven playbook for big companies that want to compete on the world stage.
So we've gone from these fast domestic fundraisers to strategic deals, all the way to these complex global offerings. For any CEO, the real challenge is figuring out which of these tools to pull out of the box for the specific job they need to do right now. And this right here, this is basically your cheat sheet. It boils it all down. You need cash fast in your home country? QIP is your move. You need to bring on a game-changing partner? Preferential allocation. You're a startup with no cash, but you need the best people? Sweat equity is your answer. And when you're ready to go global, you're looking at ADRs and GDRs.
Every single one of these paths has its own massive risks and incredible potential rewards. The choice a company makes can literally define its future for decades. It shapes its finances, its partnerships, its entire ability to compete. So put yourself in that chair. If it was your company, your dream on the line, which path would you choose?